What a time to be alive, Brent. Can you help us just break down the thesis around yesterday's rebound from a self-induced near bear market scratch, and now ultimately what the trade looks like from here for investors?
Unfortunately, I think more volatility, as you mentioned in your opening. Look, we didn't dramatically alter the overall average tariff rate. We just shifted it towards China. And so if you think about that and think about the reality that tariffs are still out there, they're still on at the 10% level, they're on at the Chinese level, and they're on sectors, we still have tariffs higher than we have in the last 100 years, even after this quote unquote pause. And so to me, that means that there's more uncertainty as we negotiate and figure out what actually happens towards the end of the next 90 days. The second thing I would suggest is that I don't think the president's overall disdain for trade in general has changed. I just think he decided yesterday that he disliked the market's route just a bit less, as well as the bond market, which I think really caught his attention, and that's why he pulled back. And so overall, we're kind of still where we were. Certainly some of the tension has come off the boil, but there's still a lot of uncertainty out there. And to me, uncertainty means that people are more indecisive, CEOs and consumers alike, and that is the risk going forward in the next 90 days.
And there's also a risk that the big bounce yesterday was driven in part by short covering. There wasn't a lot of conviction behind it, and we're certainly seeing that play out this morning with stocks down again. If there wasn't that conviction in the market, then how do you suss out where we're heading from here?
Look, I mean, some of the biggest down days occur in bear markets, obviously, and some of the biggest up days occur in bear markets. And so to me, bottoming is more of a process, not usually a singular event. Yes, the VIX has spiked to high levels, but that is not always the coast all clear sign. Indeed, if I look at Friday's level on the VIX, which many people were touting at 45.3, if I go back and I think about a year forward, that typically does lead to higher returns. But just to give an example, the VIX hit 45.3 in September of '08. We still had 38.8% downside before you got to the other side where the rewards were a year out in the future. I'm not suggesting there's 38% downside left in the markets, but there certainly is probably more back and forth. And that's where I think any investor listening needs to understand that there is still volatility ahead. That VIX is probably a good entry point for longer term investors, but certainly not the coast all clear with ups and downs and back and forth in the market. And I still would advise people to continue to diversify because the place they continue to want to buy, the S&P 500, remains expensive. But there are cheap parts of the market, and that's where I think investors should focus on who are more long-term oriented.
What are those parts of the market?
I sound like a broken record, but if you're thinking long-term, you focus on valuation. That's part of the problem about why the market's not bottoming. Even if you take a discounted PE on the S&P 500, it still looks relatively expensive. The good news is small and mid-cap stocks, yes, they are more economically sensitive, but they trade at 13 and 14 times forward earnings. If you think about international stocks, I do think you are going to see a weaker dollar in the future, much like today. That is a tailwind to international returns for U.S. investors. They trade at 13 times earnings. And so I think there's a different world in front of us, much different than what we've seen the past 5 years where U.S. stocks have dominated. And that's where I suggest that investors continue to diversify and not just buy what has won over the past couple of years.
Well, one thing that has won in the last couple of years, of course, is the Mag 7. If you had to be a buyer or a seller right now, which one would you rather be?
I'd be a diversifier. And so maybe that's the way of not answering the question. Look, I know people have concentrated there. I know that's where the beloved Mag 7 and those stocks are. But if you look historically, the same 7 names don't always dominate every single year. In fact, the top 10 names in the S&P 500 over longer periods of time, just buying those and then holding the next year has been a losing proposition. And so to me, I think the market has to broaden out no matter what happens in the next few months, next few quarters. And I think if we're sitting here 3 or 4 or 5 years from now, the Mag 7 will no longer be the Mag 7. There will be new leadership atop that. And the market cap weighted S&P will also have new leaders at the top. And so that's where I would advise people. It doesn't mean you can't own some of these. Just don't make them your sole holdings, which I'm afraid so many individual investors are doing.
Given that, can you talk to me about your thesis on the equal weight S&P? Because that, if you were in the equal weight S&P yesterday, you kind of have a bad day. So how do you make the investment thesis for that moving forward?
Look, the last 2 years, less than 30% of the names in the S&P 500 have beat the index. That is historically narrow. That happens at the end of economic cycles when the economy narrows. What has happened, at least in the last 50 years on the opposite side of that, is a broadening. This period reminds me of the late 1990s, where you had similar characteristics. You had the U.S. exceptionalism commentary. People only wanted to own tech stocks. They wanted to own the top 10 names in the S&P 500. And what happened over the next 7 years was that the S&P equal weight dramatically outperformed. That's where valuations are cheaper. They trade at 16 times forward earnings versus 20 for the market cap weighted. And that's where I think investors need to think about the future and think about the fact that valuation is not a near-term timing tool, but it does win longer term discussions. And that's where I would focus on that over top of the market cap weighted. It doesn't mean that you shouldn't own some of that. Just don't make it your sole holding, because I do think you're going to see a broadening of the market on the other side of this whenever that occurs. And I think different names will lead us going forward, just like they have in the past.
Brent, you raise a point that actually gets me to my next question, which is a lot of the volatility and the price swings that we've seen recently get people into the mindset of trying to perfectly time the market and not miss out on some of the massive jumps or the, to the downside, legs lower. So with that in mind, what are the average time spans, the portfolio spans that you're seeing from clients that you're speaking with, and how they're positioning themselves even amid some of the turmoil?
You want to know the really great news? If you have a financial plan, it takes into account the fact that markets go up and down, and that the economy has contractions and expansions. And your asset allocation takes that into account. You don't have to make big decisions on any one day. If you're one, not concentrated, there's not one huge decision because you own a lot of different things. And number two, if you have a long-term asset allocation and you stick to that long-term asset allocation, it means you're likely to get to your goals and objectives. And so to take some of the pressure off of, do you add now, do you not add now? I advise people to go back to that plan, to go back to their asset allocation, and think about that longer term time horizon. Look, if you're buying stocks today, they're probably going to be good investments longer term. But I just think people have gotten so used to instant gratification, where they buy every single dip because the Fed's going to rush in, because investors were underinvested towards stocks. That's not the case today. Americans have their highest allocation to equities they've had on record. The Fed is not going to rush in. It doesn't mean that stocks won't be a good long-term investment. It just means that there might be a little bit more time between you buying today and that instant or that gratification that you're going to have somewhere in the future.
Brent, all right, I'm going to fire up my t-shirt maker and get "I'm a diversifier" printed on that.
There you go. It's popular again.
It's popular again. Thanks so much. Good to see you,
Bringing
Brent.
it back.
Yeah, exactly.